Hey guys! Concerns about the developing global COVID-19 pandemic have sent the equity market in a tailspin. However, there will always be stocks that are better positioned to ride out the current market volatility. Here, we introduce 4 stocks with more than 80% recurring revenue owned by gurus. All 4 stocks have outperformed the S&P 500 in terms of year-to-date returns, with the average year-to-date return for an equal combination of these 4 stocks at negative 4% compared to the S&P 500 year-to-date returns of negative 18%. Investment gurus such as Bill Miller, David Tepper, Stefan Mandel, etc. are owners of these stocks. Without further ado, let's take a dive into these 4 stock counters. So for stock number 1, that is Adobe. I'm sure that most of you will be familiar with the stock Adobe. But do you know that 90% of their revenue are recurring in nature? It was not too long ago in 2013 when Adobe had about 200 million in annual recurring revenue. In its last fiscal year 2019, the company generated 10 billion in recurring subscription revenue. So what did the company learn during their transition phase from selling a product to a service? According to management, when you sell a product, the journey ends when it reaches into the hands of the customers. You don't exactly know the challenges your customers might face when using the product and how much value they're actually getting. You miss the full customer experience because the biggest part and often the most hidden part is their usage. By moving towards a subscription company, Adobe went from having an arm's length relationship with its customers to a 24/7 interaction. Adobe's revenue growth has been impressive, growing from 4 billion in 2013 to 11.2 billion in 2019, or CAGR of 18.7%. Its EPS growth has been even more impressive, increasing from 53 cents in 2013 to $6 in 2019, or CAGR of close to 50%. This is mainly due to its transition from a product company to that of a service company, resulting in an elevation of its operating margins. Don't get me wrong, Adobe has been a fantastic product company, generating operating margins of approximately 10%. However, when it transitioned into a service company, operating margins ballooned to 30%. Basically, the potent combination of high teens revenue growth, increasing operating margins, and a consistent share buyback mandate resulted in a jump in the company's EPS. A quick look at its cash flow and balance sheet statement shows that this company is also ticking all the right boxes. Its operating cash flow has been increasing in line with earnings, which is a fantastic sign. While the company has geared up in 2018, the company's debt to equity ratio remains comfortably below 0.4 times. With close to 4.2 billion in cash and short-term investments, Adobe is likely in a neutral net cash position, which puts the company in an ideal situation to ride out the current stock market volatility. All in all, a fantastic company to own with a high level of revenue visibility, even in today's climate of elevated business uncertainty. However, that is assuming you find its elevated trailing price earnings ratio of 48 times palatable. Adobe is owned by 6 investment gurus, which include Stefan Mandel from Lone Pine Capital, Daniel Loeb from Third Point, and David Tepper from Appaloosa Management. The second stock that we are looking at is called Ecolab. Ecolab is a stock which most are likely not familiar with, but owned by Bill and Melinda Gates Foundation Trust. Ecolab is the global leader in water, hygiene, and energy technologies and services that protect people and vital resources. Millions of customers use their products on a daily basis to promote safe food, maintain clean environments, optimize water and energy use, and improve operational efficiencies. During 2019, the company helped customers wash more than 40 billion hands, process 42% of the world's total milk, and reduce 1.4 billion pounds of greenhouse gas emission. With the COVID-19 pandemic issue, I would not be too surprised that Ecolab products are even in greater demand, particularly its hygiene, sanitizing, and water treatment solution. The company is well diversified by product, geography, customer, and technology, and about 90% of its sales are also recurring revenue streams in the form of consumer products such as soaps, and detergent, etc. When it comes to the financials, the company's financials have not been as outstanding as that of Adobe, with revenue rising from $13.2 billion in 2013 to $14.9 billion in 2019, or just a CAGR of 2%. On an EPS basis, it grew from $3.16 to $5.33, or a CAGR of 9.1%. With an EPS of $5.33, Ecolab trades at a trailing multiple of 29 times versus Adobe's multiple of 48 times. While there's actually quite a fair amount of long-term debt on its balance sheet, amounting to nearly $6 billion as of end 2019, this is well supported by consistent operating cash flow generation of about $2.4 billion per annum. Debt to equity stood at about 0.7 times, a multiple that has been on a downward trend. In summary, Ecolab appears to be a wonderful business with a sustainable future, potentially even doing well in the current COVID-19 pandemic. Its large recurring revenue base and long-lasting customer relationships will serve the company well for many years to come. Some of the high-profile investment gurus which own the stock include William von Merfling from Cantillon Capital Management, and of course Bill and Melinda Gates Foundation Trust, where Ecolab alone consists of close to 4% of the latter's portfolio AUM. The third stock that we are looking today is Netflix. This counter requires no introduction, and most of us probably already has a subscription with the company. Netflix is the number one stock in terms of share price performance over the last decade, climbing at an annualized rate of 45% over the past 10 years. Netflix has returned a whopping 3,726% in total since 2010. While most stocks have created to the tune of approximately 20% year to date, Netflix stock is up 15% year to date, a credible performance but not entirely surprising. This is one stock which the market believes will be a big winner in the current global COVID-19 driven lockdown that has seen more than half the globe's population under some form of stay-home mandate. So what do you do at home besides pretending to stay hardworking? I mean, of course, watch some streaming programs on Netflix, right? I have no doubt that Netflix will be a beneficiary of this current health pandemic, with a strong growth in international subscribers, despite increasing competition from the likes of Disney Plus and Apple TV, etc. With a revenue model that is almost 100% recurring in nature, Netflix seems like the ideal company to own in one's portfolio. The company grew its revenue from $4 billion in 2013 to $20 billion in 2019. During this period, EPS grew from 26 cents to $4.13, or CAGR of 58%. This is an even better performance than Adobe. But at an EPS of $4.13, the counter trades at close to 100 times trailing PER. The main grounds for me is that Netflix operating cash flow has been negative this past few years despite a strong rising revenue trend. This is due to a need to constantly invest in TV and movies production, or what is being termed as Netflix originals, to stay ahead of the competition. Such productions are definitely not cheap. Netflix turned to debt to fund a cash flow deficit. Its debt to equity ratio is now close to 2 times, and for any other company this would have been a major red flag. However, Netflix is likely a company that can continue to gain access to cheap funding due to its growing business model. In summary, Netflix is likely banking on its original content and excellent user experience, one which is not driven by ads, to stay ahead of the competition. It is also probably the cheapest form of go-to entertainment for most people after a long day at work. Surprisingly, Netflix is only owned by 4 investment gurus, with Stefan Mandel and Bill Nigren being the top gurus with the highest stake of Netflix in their portfolio. The fourth stock that we are looking today is called Check. This stock is probably one that you will not have heard of. Check is an American education technology based in California with approximately 3.9 million subscribers. Simply put, Check is a digital education platform that gives high school and college students across America the digital education companion they have needed for the past several years. Check has grown subscribers at a near 40% compounded annual growth rate since 2012. For the first time in 2019, the company recorded an operating profit of 17.8 million. Looking ahead, management expects to grow its recurring revenue by 31% in 2020. Its service revenue currently encompasses 81% of total net revenues, which means that more than 80% of the group's revenue is recurring in nature. Check, operating in the education sector has historically been resilient to recessions and can provide some downside protection. In the current COVID-19 context, the stay-at-home orders across the US might also serve as a catalyst for net new subscribers away from in-person tutoring and other similar services. The company could ultimately be recognized as a leader in online education during the crisis, much as Teladoc has been in the healthcare space. Despite generating net losses in 2019 to the tune of 9.6 million, the company generated 113 million in operating cash flow. No doubt that among the 4 stocks in this list, CHAC is the riskiest due to its loss-making nature, but could also provide the strongest share price growth potential among the 4 stocks if the number of subscribers accelerates significantly during the COVID-19 issue. CHAC, being a relatively small company with a market cap of only 4.3 billion, is owned by 2 investment gurus, Bill Miller from Miller Value Partners and Lee Ansley from Maverick Capital. In conclusion, these 4 stocks with more than 80% recurring revenue are good candidates for consideration in one's portfolio. Not only are their revenues highly recurring in nature, these stocks could also potentially benefit in a scenario where the current health pandemic sees no improvement. Adobe, with its suite of digital media products, could see an increased subscription base for its distant learning initiatives. For example, students and teachers of the company's higher education and K-12 institutional customers across the world are now getting the at-home access to Adobe Creative Cloud desktop apps. For Ecolab, its portfolio of hygiene and sanitizing products will be in strong demand during this health crisis. However, given that many of its clients are restaurants and lodging customers, the closures of their business during this period could negatively affect demand of its products. Ecolab provided a first quarter 20 guidance on 18 March with only a slight reduction of 5 cents per share price impact from the effects of the COVID-19 pandemic. Netflix will likely remain as a key beneficiary of the stay-home trend, particularly from an increase in international subscriber base. And last but not least, CHAC, with a focus on digital learning, could witness a substantial spike in its subscriber base as students transition from offline learning towards taking classes online. With that, we have come to the end of this video. Do like the video and hit the subscribe button if you find the content useful. With that, this is Royston signing out.